Here's how to maximize profits on running the wheel strategy. I made a first video going over what the wheel strategy is in detail. It's on my profile. Go view that if you don't know what the wheel strategy is. This is the second follow-up video. A lot of people asked for this. What we are going to be shooting for is a 4% return on our money. So if you have $200,000 to run on this strategy, which I know is a lot of money, that would be $8,000 a month in income that you can generate from doing this, which is a very livable wage for a lot of people. We're going to be doing this in stocks with the $5 to $15 range, because when you trade options, you have to trade stocks in lots of 100. So a $5 stock, you're going to need $500 for. A $15 stock, you're going to need $1,500 for. You can do this on any stocks of any price, but if a stock's $100, you're going to need $10,000 to do this strategy. So I'm going to go ahead and share my screen. This will be a longer video, but let's dive in. I'm going to walk you through the exact steps. All right, so I'm going to walk through this exactly how to do it. So we're going to start by screening for stocks that are $15 and under. I'm going to use the website finviz.com. It's a free website that I use. You don't have to use this website. You can use any screener that you want, or if you want to follow along, you can use this exact website too. So let's go to screener. And now we are going to choose price under $15. Now we get all stocks that are $15 and under. What we're going to do next is sort them in order of market cap. So they're $15 stocks and under, and they're sorted the largest companies to smallest. Now what you want to do is go through this list and find stocks that, one, you know, and two, you'd be comfortable owning, because you will get assigned these shares at some point when you're running the wheel strategy. So the first one I see here is Ford. Ford gets run often and talked about a lot with the wheel strategy. I'm not going to choose Ford because I know that the premiums are not that good. So let's go to the second page and see what else we have. So we have Snap, SoFi, Rivian down the bottom. Rocket Companies, a company I know, Rocket Mortgages. That one might be a good one. Let's go to the fourth page. And so here I see Lyft. I'm a buyer of Uber. I think ride sharing is a big thing. And so Lyft might be a good option here. So now let's take a look. So I'm going to go jump over to my brokerage account, and we're going to open up Lyft. And so we can see Lyft is at $12.59 right now. Let's take a look at the charts. 5 days up. 1 month is up. 1 year is down, but you can see that the stock is kind of trading in a range here, which actually works for the wheel strategy. So what we're going to do next is go to the options chain. If you don't know how an options chain works, I'll make an additional video showing that. And if you want to, type options chain in the comments and I'll send you the video when I make that one. So what we look for here is we want to collapse this. We want to find a strike or an expiration date that is 30 days out. So June 6th, 2025 is actually 30 days on the nose. If it's 31 days or 28 or 29 days, that doesn't matter, but something that's roughly 30 days out. So let's open this up, and we can see the stock right now is at $12.59. At $11, that top row, we can see that the bid is 43 and the ask is 55. We can likely get filled in the middle there at about 50 cents. So what that means is, if we do 50 cents times 100 shares, we're going to get a premium of $50. And if it does get filled, because the strike price is 11, we're going to be putting up $1,100. So what we need to do is 50 divided by 1,100 times 100 is a return of 4.5%. So that is what I'm talking about. We're over the 4%. So this strategy would be good here. And I would suggest that I could go ahead and make this purchase. So I'll go ahead, I'll click the bid. We want to make sure we are selling to open, because we're going to be selling a put and we're opening the position. And right now the price is at 43. I'm going to go ahead and up this to 50. And we can see that the estimated amount here is $50. We'll make sure that this looks good. Strategy you put, again, sell to open. The current price is $12.59, and our strike price is $11. So this means that if the stock falls below $11, I am obligated to buy 100 shares at $11, which is $1,100. And for taking that risk, I'm going to get $50 when somebody buys this contract. So you'll go to review order. There's a little bit of a commission, 65 cents. That's okay. And then an industry fee. So ultimately, I'll get $49.34. I'll go ahead and click place order, and that's it. As a reminder, as always, this is for educational purposes only. This is not financial advice.